Hey everybody, it's Daniel here from InfoRest. Hope you're all doing well. So, obviously, I gotta talk about it. We got the US inflation numbers that came out, US Consumer Price Index, CPI. It's a number that is looked at month by investors, traders, government officials, you name it. A lot of people are looking at this number because it gives you an idea how inflation is playing out from a month over month, year over year basis, depending on what you look at, and whether this number is coming down or not, and what this may mean when it comes to interest rates, whether we're going to see cuts, whether we're going to see hikes, and so on. So I talked about interest rate cuts in my last video, especially about UBS, who expects to see about 275 basis points of rate cuts. You can watch that on the channel. Just search it up. It was released yesterday. And today we're going to talk about and dive deep into this inflation report metrics. I'm going to talk about a couple of things to keep an eye out on, what came out in the report, a couple of numbers that even the Fed looks at. What is the Fed looking at? And they talked about a key number, which I'll also discuss when it comes to their decision making, when it comes to interest rates, whether they're hiking or cutting, and so on, right? And we're going to talk about the market's reaction and what this could mean in terms of the economy, stocks, and so on. Okay, so first off, we're going to talk about what the numbers came out today at 8:30 a.m. We had the CPI number, headline number, which includes gasoline and so on. So the month-over-month number came in flat at 0 versus the expected 0.1%. So that came in lower than expected. When you look at the year-over-year number, the headline number is sitting around 3.2%. Remember, the goal of the central bank is to achieve 2% inflation target. So the headline number is at 3.2% because gasoline, right? If you're watching crude oil and some of these future products, gasoline, crude oil, so on, energy, the prices there have been seeing somewhat of a decline, and that's what's contributing to the number being at 3.2%. Now, when you compare to the previous month, right? Previous month was 3.7%, so it's lower than the previous report. And the expectation where market participants were basically guessing the number was going to come at 3.3, but it actually came at 3.2, so slightly lower. So that is good in terms of when you're comparing the expected number. But however, when you look at this headline number from past couple of months, you can see here that 3.7 was the previous number. The month before that, right, we had 3.7%, and then we had the number before that, 3.2, and then 3. So it's been ranging. If you look at it, the number's been ranging around 3% to 3.7. So it's in between this range. We haven't really made massive strides yet when you look at the year-over-year number. Okay, but 3.2% versus the expected 3.3% is good for now, good for the markets, and so on. When you look at the core number, now the core number takes out volatile numbers like energy, takes out energy out of the component, right? So it looks at kind of more stable prices or goods and services that are more stable, right? So that number, the month over month number, came at 0.2%. The expected was 0.3, so lower than expected, which is good. And the year over year number came in at 4%. And the last month's number was 4.1%, and the expectation for this month was 4.1%. So if we look at how the number played out, last month, like I said, 4.1%. The month before that, 4.3%. The month before that, 4.7%. So we're seeing a nice decline in the core number, but still sticking around the 4% handle, right? So we're around the 4% area. As of today, we're at 4% exactly, but lower than the expected which is a good thing and lower than the previous month. So what was the market reaction? Stocks and bonds immediately ripped up, right? So we saw stocks rally, bonds rally. Why did that happen? Why was that the reaction? Because it's showing you signs that, inflation's not really creeping up. Although the year-over-year number is moving sideways, the core number is coming down slowly. Signs that inflation is getting weaker and weaker. Could there be a pickup in the future? Sure, maybe, maybe not. We'll see then. But because the number came in lower than expected, it caused optimism because it has to do with rate hikes. So the expectation of a rate hike for next month, December, dropped even further, right? So there's almost 100% probability that there's not going to be any rate hike for December. Now remember, we still have more data coming out in December. We've got other growth data that's coming out in the beginning of December, jobs data that we need to look at, and we have also another inflation metric to look at as well. But very likely that the Fed's going to continue to be in pause mode, right? So since a couple months, if you notice, the Fed has been pausing and haven't been hiking rates at all. And very likely that next month they're not going to hike unless the number comes really horrendous and higher than expected. That completely shifts the probabilities, but I doubt it. And I think it's likely we're going to see the pause continue even in December. That leads to the next question. Okay, what about next year? Right? Could we see a hike? Could we see maybe cuts? Right? Again, it comes down to what happens in terms of inflation. Does it spike up aggressively? Is there going to be a catalyst that causes it to spike up? What's happening with crude oil, gasoline, prices, demand, so on, supply chain constraints, war? These will all have a factor into next year. Now, at the same time, we also heard from the Federal Reserve come out in previous week and so on, where we heard Powell and also other Fed members say that, we need to see a couple of inflation reports, couple of data to say that we're done hiking. Couple of data and don't think that we can't come back to hike next year. They definitely can. That's still on the table. But if you're seeing the trend, and let's say, right, we talked about 3.2% headline, 4% core. If that number starts to drop even further and further, then there's less likely of a chance of a hike, and they will continue to be in pause mode. Now, the markets see, right, they're predicting a cut, first cut in July. This is what the money markets, the bond markets are pricing in. That you're going to see a cut start in June, not July. So July they're pricing in before, but with this new inflation number, they pushed it earlier. That okay, you might see the cut actually show up in June, not July, and it's still going to be 3 cuts, 75 basis points of rate cuts for next year. Obviously, in my last video, I talked about UBS, who sees much more than that, 4 times that, sees basically 275 basis point rate cuts, sees an easing cycle, and that basically means that they probably see a hard landing recession, right? So this gave optimism in the equity markets and the bond markets because it signals Fed is basically done. They're in pause mode. They're gonna, now what comes after a pause? Well, if you look at every cycle, you have rate hikes, and you get a pause, and then you get rate cuts, right? So now the markets are looking forward to, okay, where are the rate cuts going to come, when it's going to come, because that's what happens after you've been in pause for quite some time, and very likely, this is the market talking, not me, very likely that we're going to continue to see pause continue as the data weakens and weakens. Therefore, euphoria in stocks going up close to July highs, Nasdaq's about 5 to 6% from all-time highs, right? If you remember, last year we sold off from January and we were selling off, selling off, selling off. Guess what? That point is coming closer. We're seeing Nasdaq approach 5-6%, and it can definitely clear that and reach to all-time highs, who knows, by the end of the year, especially if data continues to move in this direction, right? As long as nothing is breaking aggressively, the unemployment rate's not skyrocketing, jobs are not crumbling, and inflation's coming down, guess what? 100% you're going to see all-time highs. 100% we're going to test the all-time highs. We probably won't even break, we're going to break it, and there's going to be more euphoria. So you're seeing stocks move up on, I guess you could say, well, this is soft data, right? I was going to say bad news, but you got bad news as good news coming back into play in the stock market, and you're seeing bonds, being a very good trade here, where weak data is propelling bonds higher. So you're now seeing stocks and bonds move up, right? If you remember in 2022, we had both stocks and bonds sell off on tightening, on QT, on rate hikes. Right? So if you were a pension fund, if you had, 50% allocation in stocks, 50% allocation in bonds, you would think that if stocks are selling off, bonds are going to help, offset those losses. In fact, no, you were down overall 100%. Your whole portfolio was down because both stocks and bonds sold off aggressively, even bonds, because of all the tightening, right? If you look at bonds, sold off about 50%. So this brings back to a couple of things that a lot of people are talking about out there in the markets, talking about 1995. 1995 is a very good example of what soft landing looks like. So a lot of the markets are basically pricing in, and there's basically a Bank of America survey that asks these fund managers the probabilities of a soft landing. And basically, it says that 75% of investors believe that they will get a soft landing here, right? So in a soft landing scenario, if we look at 1995 all the way to 2000, 2001, and when the bubble finally bursted, the Fed engineered very nicely a soft landing, because in 1994 the Fed hiked from 3% to 6%, and this sparked a lot of fears in the market, saying that, hey, we're going to see a hard landing in the US economy. Rates have gone up too aggressively. It doubled from 3 to 6%. Market's going to crash. But early 1995, the US economy is still adding 150,000 jobs per month, while core inflation had slowed down a bit and basically allowed the Fed to cut rates by 50 basis points that year, right? In 1995. And what happened in 1995? Stocks went up almost close. US tech basically went up about close to 40%. You had small cap stocks go up close to 30%. US large cap stocks up 37%. And you had bonds, right? High yield bonds go up 20%. Gold up 1% for that year. Global ex-US equities up 4%. And long end treasuries, bond on the long end, went up 30%, right, in 1995. And then if you look at 1996, 97, 98, 99, it was just a nice straight line up until we hit 2020, where 50% of the move was corrected from the tech bubble bursting, and it came back to basically 1997 levels, right? 50% retracement there. So this is your, why I'm bringing this up to you, the 1995 model, is because that is a very good example of soft landing, and that's a very good example of how everyone is talking about today, that we are in soft landing. This is soft landing. We expect soft landing. Although, you do have UBS few strategists there who doesn't expect soft landing. You do have some investors and traders who don't expect soft landing. So I would actually argue that this is the soft landing that we are in right now. We are in soft landing right now because inflation's coming down and jobs data is not deteriorating that bad. Now, does that mean that we're going to remain in soft landing and not go from soft landing to hard landing? No, we don't know. We will see. We will assess according to how the data plays out with rate hikes and so on. And we will see. Time will tell us whether we will remain in soft landing or not, whether the Fed did the perfect job to engineer a soft landing, right? If not, then what comes after a soft landing is obviously the hard landing, the massive crash, the unemployment rate skyrocketing heavily, their jobs deteriorating, go from disinflation to deflation probably, and it'll probably come up from an event, a credit event or some sort there, right? 1995, there was, I don't remember any event that caused the markets to sell off, and probably that was a catalyst for things to continue to go up higher and higher, and many other things, right? That you could argue. So very interesting that you're getting investors start to really hop onto the soft landing play. And if that's the case, don't be surprised if equities continue to rally. Bonds, like I told you here, 30% rise in 1995. Bonds also rallying. So you could get, 2022 was the year of both stocks and bonds selling off. Maybe 2024 might be the year of stocks and bonds both going up, right? Unless, like I said, unless the soft landing is not what people expect, investors expect, and we get a hard landing, crash, credit event, some sort that completely skews everything up, right? So for now, yes, okay, let's say we're in soft landing for now, and things are looking rosy and good, and equity markets are high and happy. Now, let's go into the CPI report. Comes out from the BLS, and let's read here and look at the chart here on what they have to say. So I'm going to read a couple of paragraphs here. The second paragraph I'll start off with basically says the index for shelter continued to rise in October. So, okay, even though we didn't increase, inflation didn't increase more than expected, you still had components that went up, aka shelter, right? Shelter went up still in October, offsetting a decline in gasoline, like I said, gasoline and energy, resulting in seasonality, adjusted index being unchanged over the month. The energy index fell 2.5% over the month, as 5% decline in gasoline index more than offset the increase in other energy component indexes. The food index increased by 0.3% in October after rising 0.2% in September. So food got more costly there. The index for food at home also increased 0.3% over the month, while the index for food away from home also rose 0.4%. So even though inflation has come down, the number has come down less because of gasoline and energy. Your food is still expensive. Food at the restaurants, food at home, groceries, you name it, they still went up, right? Next paragraph says the index for all items, food and energy, rose 0.2% in October, after rising 0.3% in September. Okay, we know that. Indexes which increased in October include rent, owner's equivalent rent, motor vehicle insurance, medical care, recreation, and personal care. The indexes for lodging away from home, so they talked about shelter, rent obviously went up because of the higher rates that are still sticking around. Now, lodging away from home, right, and used cars, trucks, communication, airline fares were among those that decreased over the month because food is expensive, shelter is expensive, your essentials in life are expensive, leaving less room budget for people to go out and take a flight and go on vacation, etc., right? It'll be interesting to see how retail sales comes out, especially during the holidays, especially during Christmas and so on. So that will be very interesting to watch out for. Now going into the chart here, what I see here, like I mentioned, food at home, food away from home, all up for the month. Decline is seen in energy. Let's see anything else here. Used vehicles, new used vehicles, yes, did come down. So if you're in basically shopping for a car, you're starting to see prices come down, and probably you will see a continuation of that, for prices to continue to fall. Apparel slightly up, medical care commodities higher, shelter up 0.3%, transportation services up 0.8%, medical care services 0.3%. So even though inflation has come down, it's still sticking around, and those sticky variables are the essentials that people, live off of. Food, water, shelter, right? That's still expensive. Go to the groceries, it's still expensive. So when you really dive into the CPI report, is it really a win? Is it really a win? Maybe slightly, as overall the price is coming down, and the gain is being offsetted by gasoline and energy, but you still have shelter still up there, right? If you look at the unadjusted 12 months ending in October of this year, if you look at, let's say, food, it's around the inflation metric, food at home. Well, let's first talk about food. Food as a whole is 3.3%. Food at home, 2.1%. Food away from home, 5.4%. So still up there, right? And what else? Let's look at also other components that are really important. Transportation for unadjusted 12 months ending October 2023, 9.2%. What about shelter for the year? 6.7%. So these numbers are still high. They're still high up there, right? Now let's get into a number that the Fed is looking at. Now the Fed looks at the core. The Fed does look at the headline number. See, numbers are coming down. But remember what the Fed told us a year back. They're looking at the super core number. Now, what is this super core number? Well, the super core number basically takes all those numbers I'm telling you, and they exclude food, they exclude shelter, and energy. Okay, so you take shelter out, obviously, the number is going to look lower. You take food out, number is going to look lower. Taking energy out, right, could help with the decline, but also the number is expected to be lower. So this super core number is very funny to me personally, because you're taking the most important items there, food and shelter, right? Really important. These are things that people still feel the pinch on, right? And why is that? Because if you look at an average individual's budget, right, they tend to say don't have more than 30% of what you make in your budget, that you have more than 30% into your housing expenses, your shelter. But a lot of people out there, pay more than 30% of what they make, depending where you live also. Some are doing 50%, 60%, right? So your mortgage cost, your rent, these are things that are eating a big chunk of what you make. So if you remove that from the CPI data, then is it really important to follow and track? Well, according to the Fed, they told us it's very important, it matters to us, and we're keeping an eye out on this number. If this number is coming down lower, it tells us good signs in the inflation metrics. Okay, I don't agree with that, but hey, since the Fed's looking at it, let's look at it too. So what did the number come out for the super core number? Number came out at 0.1%. So, if you look at the August number, the last month's number came out also 0.1%. The month before that came out at 0.3%. Right? So the number came in lower for the super core number, also a green light for equities and bonds because the Fed's looking at it. Although we know That's very silly and stupid, because you're basically taking majority of the items out of the inflation metrics. It's really stupid, right? What's in the super core number, if you're wondering? Well, what's in it is water, sewer, trash collection, medical care, transportation, recreation, education, communication, and other personal services. Basically services. Basically, services is what the super core number is. So they took CPI, they took inflation, and they're like, shelter is going to probably be sticky for some time. Let's take this out, even though, a lot of money money goes into someone's income. Big portion of it goes into shelter. Food, let's take that out. Oh, gasoline, this, let's take this out. Cars, blah, 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 whatever it is, right? Let's take these components out, which are the most important components, at a point which makes me laugh, because obviously if you take out these important items that are sticky and you skew the data, which is basically what's happening here in the super core number, you obviously can make it look like you're winning, right? It's like saying that let's play soccer here, and let's bring the goalpost close, the opponent's goalpost closer to me. I'm going to do a penalty kick. Let's put maybe a 5-year-old as the goalkeeper. Obviously, I'm going to have a better chance at scoring, right? Same thing here in the super core. You're playing with the numbers and you're adjusting it to make it look good, right? When actually, in fact, the numbers are showing signs of stickiness. Signs that it still hasn't come down yet. Signs that the Fed looks like it needs to do more. It still has a lot of work that in order to bring inflation down. Now, out of all this CPI data, there's one important crucial thing that I did not mention. It's that the Fed's communication, its reaction to the data. We have yet to hear from the Fed a confirmation that yes, this is a data point that's good enough to stay in pause and to now think about cutting. The markets are getting out of hand and anticipating the Fed's done, we're going to see a cut soon. But the Fed comes out every single time and says, we're not done. We still need to fight inflation. We have a long way to go. We need to see multiple reports of inflation before making a decision. So the Fed is still not on board. The market and the traders are thinking otherwise, but the markets are completely ignoring what the Fed is saying in terms of the communication, because the Fed is saying one thing and acting another. They're saying we're not done, but they've been in pause. They're saying we're not done, but they haven't hiked yet, right? So the markets are calling the Fed's bluff, like, no, you're done. You're most likely going to cut next year, and this is how it's going to go. And the Fed's actually following what, most people are predicting right now. The only thing to watch out for is that how bad does this data get? Are we going to get 1995 kind of soft landing and remain in soft landing? And what does that mean? If you look at 1995 to 2000, that's a nice 5-year bull run. Do we get the same thing? 2024 to, let's say, or 2025 to, let's say, all the way to 2030. Do we get a nice bull run there as well, right? Or not? Do we get the credit event? Do we get the crash? Do we get not disinflation, but deflation? Do we get, panic in the banking system, crashes, so on? Do we get that? That's a question we'll have to assess and see according to what comes out from the data and from future events and news articles, and most important, the banking sector, right? Let's not forget, got commercial real estate problem there. Let's not forget, we got a lot of renewals for commercial real estate and residential, also depending where you live in. Let's say Canada, RBC, Royal Bank came out and said that a lot of renewals are going to happen at end of next year, 2025, 2026. If rates don't come down low enough, it could be a problem. Same thing with commercial real estate in the US and in Canada. Rates don't come down low enough. Even if rates do come down, how low is low enough, right? Even if you do get 75 basis points to 100 basis points, that's just taking rates from 5% to 4%. Is that still not enough? Right? I think it's not. I think it doesn't make much of a dent, right? It will probably create panic. So let's see. Again, we're in soft landing until proven wrong, until things change, and it'll be interesting how things play out, especially when we head to approach close to the end of next year. I think we will get a very good idea how this economy is playing out. Anyways, let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers. Bye.